In 1979, a single number predicted one of the greatest silver explosions in history. Nobody talked about it publicly. No mainstream outlet covered it. But the traders who understood that number made generational wealth in under 12 months. That same number just appeared again. Today, in the current market, hiding in plain sight. And I'm going to show you exactly what it is, what it means, and why the people who understand it are quietly repositioning right now while everyone else debates whether gold at $4,680 is too expensive. The hidden number. The number is 53. That is the current gold to silver ratio. And if that number means nothing to you right now, it will by the end of this video, because it is the single most important signal in the precious metals market today. And almost nobody in retail investing is paying attention to it. Here is what the ratio actually means. Divide the gold price by the silver price. Right now, that gives you roughly 53, meaning it takes 53 ounces of silver to buy 1 ounce of gold. 1 week ago, that number was 62, a 10-point compression in 7 days. In the world of precious metals, that is not a small move. That is a violent, fast, institutional-driven repositioning. And when you understand what has historically happened after this kind of compression, the next 60 days start to look very different. What history actually shows. Let me give you 3 moments in history where this ratio compressed rapidly and what followed. 1,979. The ratio dropped from the 40s toward 15. Silver went from roughly $6 an ounce to $49 in under 12 months. A 700% move. Not because silver suddenly became more useful, because the ratio compression signaled that institutional capital was rotating out of gold and into silver at extreme velocity. 2011. The ratio compressed from around 65 down toward 31. Silver ran from $18 to $49 in 8 months. A 170% move. Again, not driven by retail sentiment. Driven by the ratio signal that smart money was aggressively accumulating silver relative to gold. 2020. Pandemic panic pushed the ratio to 125, an all-time extreme. The moment that extreme reversed, silver rallied 45% in the following months as the ratio compressed back towards 60. Today, the ratio is at 53. We are not at a historical extreme, but the direction and the velocity of compression are matching the early stages of every one of those historical moves. The ratio is not a guarantee. Nothing in markets is. But it is the closest thing precious metals traders have to an institutional positioning signal. And right now, that signal is flashing. Why this is happening now? The real story. Here is where most financial content stops. They show you the chart and leave you with the signal. I want to give you the actual reason. Because understanding the mechanism is what separates investors who react from investors who anticipate. Silver has 2 demand engines that gold does not share. The first is monetary. Silver has been money for 5,000 years. When confidence in fiat currency erodes, when inflation stays stubborn, when central banks lose credibility, when geopolitical tension makes paper assets feel fragile, silver attracts safe haven capital alongside gold. The second is industrial. And this is the engine that is firing right now in a way it has never fired before in history. Silver is the most electrically conductive element on Earth. And the industries that need it most are growing faster than at any point in the past century. Solar energy. In 2014, solar manufacturing represented 11% of silver's total industrial demand. Today, it represents 29%. And global solar capacity is projected to triple again by 2030. Artificial intelligence infrastructure. Every AI data center requires massive electrical systems. Every high-performance computing chip requires silver. The AI build-out happening right now is a silver demand story that almost nobody is discussing in mainstream finance. Electric vehicles. Each EV uses significantly more silver than a traditional combustion engine vehicle. Global EV production is accelerating, and all of these industries, solar, AI, EVs, semiconductors, share one critical supply chain dependency: China. Which is exactly why what happened in Beijing this week matters so much. Beijing and the supply chain signal. Right now, as you watch this, Donald Trump and Xi Jinping are in Beijing for the most significant US-China summit since late 2025. 60% of silver's annual industrial demand flows through US-China supply chains. When trade conditions between the US and China improve, manufacturers increase production plans. More production means more silver orders. More silver orders mean prices move. This is not speculation. This is how commodity markets work. Silver jumped before this summit began because institutional traders, the people who manage billions of dollars in commodity exposure, understand this supply chain relationship better than most retail investors do. They positioned early. The price moved. And retail investors are now asking why silver is rising when gold is falling, completely unaware that the answer was already embedded in the Trade Summit news 3 days ago. This is the information gap that costs retail investors returns every single cycle. The problem gold is facing right now. Now, let's talk about gold, because understanding why gold is under pressure today is just as important as understanding why silver is climbing. This week, the US released April's Consumer Price Index. Inflation came in at 3.8%, higher than the forecast of 3.7%, the highest reading since May 2023. Producer prices also came in hotter than expected, the biggest monthly PPI gain since early 2022. Here is the mechanism most people misunderstand. Gold is a non-yielding asset. It pays no dividend, no interest, no coupon. When you hold gold, you are foregoing whatever yield you could earn from bonds or other interest-bearing assets. When inflation is high and the Federal Reserve is expected to cut rates, bonds become less attractive, gold's opportunity cost falls, and gold outperforms. But when inflation is high and the Fed is trapped into keeping rates elevated or worse, considering rate hikes, bonds become more competitive, gold's opportunity cost rises, and gold faces selling pressure regardless of how bad inflation actually is. That is the exact trap gold is caught in right now. Inflation is too hot for the Fed to cut. Rate cuts are priced out for all of 2026. Traders are now pricing in over a 70% probability of a rate hike by early 2027. Gold is fighting the math of elevated rates at the same time that silver is being powered by industrial demand that Fed policy simply cannot touch. A solar panel factory does not care about the federal funds rate. An EV manufacturer does not reduce silver orders because Jerome Powell held rates steady. This is why gold is falling and silver is climbing simultaneously. Two metals, two different demand structures, two completely different outcomes in this specific macro environment. The supply deficit, the story beneath the story. Everything I've described so far is the immediate picture. Now, I want to give you the structural picture, the one that takes years to build and decades to resolve. The world has consumed more silver than it produces for 6 consecutive years. Not 1 year, 6 consecutive years of the world using more silver than it mines. The 2026 supply deficit is projected at 46.3 million ounces. That is 15% larger than 2025's deficit. Since 202176, 2 million troy ounces have been drawn from above ground stockpiles to cover the gap between what mines produce and what the world consumes. Here is the economic reality of sustained supply deficits. Every year, the deficit continues. The buffer of above ground silver available to cover future deficits shrinks. At some point, and the timing is impossible to predict precisely, that buffer becomes insufficient. The only mechanism left to balance supply and demand at that point is price. Higher prices reduce marginal demand. Higher prices eventually incentivize new mining investment. But new silver mines take 7 to 10 years to bring into production. This is the structural setup underneath all the weekly price action. The CPI prints, the summits, the Fed meetings, these are the immediate catalysts. The 6-year supply deficit is the fuel that was already soaking the market before any of this week's headlines existed. And here's the number that puts all of this into perspective. Commodity analysts who model silver prices using copper as a benchmark because 94% of silver's weekly price moves are explained by copper movement, currently show an implied fair value for silver of $99 per ounce. Copper is trading at $14,000 per ton. The model says silver should be at $99. Silver is at 80. That $11 gap between current price and model implied fair value does not stay open permanently. Markets are inefficient in the short term. They are brutally efficient over time. The risk you need to understand. I will not give you a one-sided thesis without showing you the risks. That is not analysis. That is marketing. India just raised import tariffs on gold and silver from 6% to 15%. India is one of the world's largest physical silver consumers. Higher tariffs directly suppress Indian demand in the short term. That is a real headwind. If the Beijing summit produces weak commitments or collapses entirely, the industrial demand trade partially unwinds. Silver could test the $82 to $85 support zone meaningfully. If US inflation accelerates further, the Fed rate hike probability grows and gold's pain deepens. Silver, being partly a monetary metal, would feel that pressure too. These risks are real, not theoretical, real. But here is how I weigh them against the structural case. India's tariff is a government policy decision. Government policies reverse. The 6-year supply deficit is mathematical reality. It does not reverse with a policy announcement. A failed summit is a sentiment shock. The underlying supply chains between the US and China still exist the morning after. Manufacturers still need silver regardless of political weather. Fed rate hike risk is genuine, but it affects gold's monetary premium far more than silver's industrial demand engine. Weigh the risks, honestly. Weigh them against the structural setup, honestly. Make your own decision what smart money is actually watching. Let me tell you the 3 signals that professional precious metals traders are tracking right now. Not price, not headlines. These 3 specific signals. Signal 1, the gold-silver ratio breaking and holding below 50. That level has historically marked the beginning of the most aggressive phases of silver bull markets. We are at 53 today. The direction is set. The confirmation comes at 50. Signal 2 volume on silver's upside moves. Price moving on low volume is sentiment. Price moving on high institutional volume is conviction. Watch whether silver's moves above $88 are confirmed by genuine volume expansion, or whether they are thin, easily reversed moves. Signal 3, what comes out of Beijing? Not vague diplomatic language. Specific commitments around tariff timelines, supply chain frameworks, and technology trade. That is the signal the industrial demand trade is actually positioned around. When all 3 of those signals align the ratio below 50, volume confirmation, and a genuine trade framework from Beijing, the setup that existed in 1979 and 2011 starts to look genuinely comparable to today. Step back from the weekly price action for a moment. What you are actually watching in the gold and silver market right now is the collision of 3 forces that rarely appear simultaneously. A global monetary system under quiet but measurable long-term pressure. Central banks buying gold at record pace. BRICS nations building alternative settlement infrastructure. Sovereign wealth funds. Increasing hard asset allocation. These are not retail investor decisions. These are institutional decisions made by people managing national reserves. An industrial revolution that requires silver at a scale that has never existed before in history. The electrification of everything, energy, transportation, computation, runs on silver. And the world cannot electrify the way current projections demand without dramatically more silver than current mines can supply. And a geopolitical environment that has made the concept of financial safety more complicated than at any point since the 1970s. A closed Strait of Hormuz, a US-Iran standoff with no clear resolution, a US-China relationship being renegotiated in real time, energy markets, feeding inflation, feeding monetary uncertainty, feeding the case for hard assets. Gold and silver are not just commodities in this environment. They are the market's answer to a question that the global financial system cannot currently answer cleanly. What do you hold when you are not sure what to trust? 5,000 years of human history has a consistent answer to that question. Right now, That answer is trading at $4,680 for gold and $88 for silver. The ratio between them is compressing at a pace that has historically preceded some of the most significant precious metals moves in modern market history. Whether this time produces the same outcome, that is something the next 60 days will begin to reveal. But the data is not ambiguous about the setup. The setup is real. The signals are real. The structural story is real. What you do with that information is entirely up to you. If this video gave you something that most financial content doesn't give you, not just what is happening, but why it is happening, and what the historical and structural context actually means, then I want to ask you one thing. Subscribe to this channel, not because of this video specifically, but because this is the standard I intend to hold every single video to. Institutional grade macro analysis. Explained clearly enough that any serious investor can actually use it. No hype, no manufactured urgency, just the signal and the honest context around it. The next video I am releasing covers a specific development inside the Federal Reserve's internal framework that most retail investors have never heard of. A mechanism that, if it activates, changes the gold thesis for the second half of 2026 completely. Not in an obvious way, in a structural way that takes time to understand but completely reframes what you thought you knew about where gold goes from here. That video is coming soon. Subscribe and turn on notifications now, because once that content is live, the investors who saw it early will have a meaningful head start on everyone else still trying to catch up. And one final thing, drop your answer in the comments right now. Based on everything in this video, the ratio at 53, the 6-year supply deficit, the copper model implying $99, where do you think silver ends 2026? Give me your number. I read every comment. I respond to the ones that make me think. And the most insightful response in this thread I will feature in the next video. That is not a gimmick. That is how I want to build this community. See you in the next one.